Good morning. I'm not sure where everybody is, but it's nice to see you. I understand some people, I did say that I'm not going to take attendance, but I didn't expect so few people to attend the live streams. I don't think this is intended for more than half the class not to attend, right? That means they have to watch these and catch up. Now the next test is in 2 weeks, and I have to cram in a lot of stuff, and I don't know when you're gonna have time to review that if you aren't watching the videos on time. So it's great for the people who are here, and I guess we will have to hope that the others have the time, find the time to watch 6 hours of videos in addition to studying. So if you can communicate with the other class members, make sure that they realize that they're expected to watch all of these, and this is assumed information. I'm not going back, I'm going forward, right? So whatever I've talked about so far has culminated in this summary here. And that's what I want to talk about next. All these formula, which I've already introduced, most of them. Okay? So I'm going to wrap up the review of statistics using the two variables that are financial variables, financial data. And although we could talk a long time about statistics and statistical methods, this is all you really need, okay, for this class. These techniques. I'm trying to think. I think these are all the formulas actually on this page. So you should keep these, you should print this page and you should keep it at hand for you, all right, for the next, while we go through the notes and for this next unit of material. Next class will be included, so this class, next class will be included on the test, and even, so let's see, let me write that down. So we have November 13, Friday the 13th. It's a good luck number for Italians. So I hope all goes well today. November 20th and then the 27th. These are all, so that's 9 hours of instructions. Okay, all of that will be examinable material. On the 27th, I'll spend some time doing review problems if necessary. You only have a portion of the exercises that I've sent you so far. I'm going to have to send more notes as well. So you'll have the next 2 weeks to study. Well, yeah, it's 2 weeks. 2 weeks. Okay. So we left off here talking about X and Y. Now, two variable statistics. And I asked you, the people who were there in class, what is the relationship between these two variables? And when you look at them, you see that Y is double of X. And then what I did was I went into my calculator and entered these values. So let's just do that again while we wait for people. All those people we're waiting for probably need to see it. I guess they'll see it in the video. So we're going to enter these values into the calculator and get our results. And let me... One second. I have to pull up on my computer. So going into the calculator, let's clear what I have there. Well, first I want to go into the data function. There's information, so I need to clear that. Second, clear work. And start entering the pair of values as I can enter them as decimals or percentage. So decimal, 15%, enter down, and then its pair is with 0.3, enter down. The second pair is 9 and 18. The next pair is 10 and 20. Oops. The next pair, 7.5 and 15. And the next last one, 8 and 16. And let's review what I have put in here because I think I made a mistake. Let's see. So 30, no, 15, right, and 30, 9 and 18, 10 and 20, 77.5 and 15, and 8 and 60. Perfect. Now I ask for the results, second stat. These are the linear results, so I'm going to get the sample size, the mean and standard deviation of X. With the standard deviation of the population, I ignore that because this is just a sample. Then Y, mean, standard deviation, and I ignore that because that would be if the data was from the population data, but it's just a sample. And this gives me now the results of the line. A is the intercept, which is 0, B is the slope, and R is 1. What does it mean? It means that the observations, which are pairs of data, fit perfectly on a line with a slope of 2 and an intercept of 0. And I attempted to draw that there. Fit perfectly on the line. So the R equaling +1 means they fit perfectly on the line. The B is the slope. So that's recapping the end of last class. Now, I explained also that the slope indicates that the relationship, well, like we see here, very simply, that it's perfectly double. And the interpretation is that as we always put the market index here as a measure of an indicator of market performance or the performance of the economy. Okay, that's how we look at it. How good it is, how strong it is, or how weak it is. And then we say if there's a shock or an impact on the market that raises, let's say, by 1% the index, then that means that the Y variable, in this case the stock returns, will be impacted by 2%. Because it's a slope, that could also be seen in the adverse event of a loss of 1 percentage point in the market index. That'll have a worse, proportionally worse effect on the stock return for BCE, Bell Canada Enterprise. Right? So what do we have? I showed you the mean, the standard deviation, and I told you about the R, but we never calculated it. So let's talk about R, and then we're going to talk about B. All right, but you know the results, so keep those in mind. R is, as we discussed, a measure of direction and strength of a linear relationship between two quantitative variables. And the best way to introduce it is like this. This is the formula for R. And so now you see numerically what I was doing with my illustrations, showing you, if remember we were dividing the scatter plots I was doing this, I was saying let's go halfway, and let's go halfway. Remember this discussion? And then we were talking about when x is high, y is, so x high, y high in general. And when x is low, y is low. When x is above its mean, so we divide the data into two parts, high and low, by the mean. When x is above its mean, y is above, it tends to be above its mean in this quadrant. When x is below its mean, y is mostly low relative to its mean. So this is an indicator of a positive relationship. That's how we interpret it. Now let's look mathematically. That's what's reflected here. What we do is we do this. What is this? To x, and we do this to y. What is this? Oh, back to Von Meidy's question. I'm interpreting as percent because percentage is the unit. That's why I'm saying percent. Okay, so if it was a different measure, I would mention it. Is that all right? So, what is this called? Nobody? What is this? What is this thing that I'm doing here? It's like x minus the mean divided by the standard deviation. What is that? Ah, right, you're right. There is a recesso. I forgot. Yeah, you're right. So yeah, we won't have class on the 27th, so you're just gonna have to study. Okay? Yeah, I don't know why I forgot. So yeah, we have this class and next class. So what is this called? Who's there? No, Mariana, but some idea like that. What is this? When I take the value and I minus the mean and divide by the standard deviation, what is this called? What am I doing? When do I do this? No, that's not it. Come on. Are you guys going to force me to do this? Okay, so if I take these values, so if I made a table, Now I have all these numbers from the calculator. I have all these values. X bar and SX. I think I also give them in the handout. This is 0.099 and SX is I have to go pull it out because I don't remember. So it was 0.03. That's good. Okay, so SX is 0.03. Now, if okay, let's do the Y's as well. And then Y bar and SY, the mean of Y is 0.198 and SY is 0.0602. I'll just use 0.06. And what you will see is if I calculate doing this, did anybody write what it's called? Very good, you got it. The standardization, computing z-scores. Perfect, there, you got it. I got it out of you. Yes, it's called standardizing. And why we do it is so that we can make the values comparable. So like this, watch me here. If I take each value and standardize it, I subtract the mean and divide by the standard deviation, I reduce the number relative to the mean. Remember, statistics is about averages and relative measures. So I'm going to reduce every value to a measure relative to its mean by standardizing it. So I take this minus that and divide by that. Let's do that together. So I'm going to take 0.15 minus 0.099 divided by 0.03. And I get 1.7. So I get 1.7. Now these aren't necessarily z-scores because I don't know if the underlying distribution is normal, but I can assume it. I can standardize anything, but it's only meaningful when you do it on symmetric data. So that's 1.7. Let's do it for y now. So the y values were double, right? So it was 30, 18, 20, 15, and 16. Okay, so I did this one here. Now let's get the y. So that's going to be 0.3 minus 0.198 equals divided by 0.06. And it's identical. So even though the original numbers are double, the standardized values are identical. You see, and that's going to happen all the way down. So it means that when x is above its mean by 1.7, y is above its mean exactly by 1.7. So those will both be positive. When I multiply them, I'll have a positive, and essentially I'll be adding in a positive to this sum. If some are below the means, like this one, 4, when this one is negative, this one will also be negative. Let's do that one. Let's do this one. So I'm going to take 0.075 and I'm going to subtract 0.198 and I'm going to divide by no, I did the wrong thing. I was asleep. Let's do that again. It's going to be 0.075 minus the mean of x bar is 0.099 and then divide 0.03. It'll be a negative 0.8. And then for the y value, .15 minus 0.198 equals divided by 0.06, and I should get the exact same number. Right? I got exactly the same number, you see? So that is what we're doing. We standardize the values to turn them into numbers relative to their means, multiply them. Even when one's a negative, the other one will be negative, and that will add another value. So this will make R positive. Then I take the average of those values. How's my explanation of this formula? You need to know this because I'm going to use this again. Oh, you can't see. Let me put it higher so you can see the numbers, sorry. Oh, I can't. No. So let me do this. I'll move. You should have all the values in your calculator. Let me give you a moment to stare at that and see it's exact. Okay, so we're converting the observations into relative measures relative to the means of the respective variables. And we see it's exact. The exactness is what R picks up. And in this case, perfectly positive. Okay? So this formula can be written like this, but you might have seen it other ways. How else can I write this formula? When I teach this, I like to write it like this because it explains what the formula is doing. Okay? It's a nice way to explain the formula, but I don't have to write it like that. Sx and Sy are just constants. I'm just using this value for them. And X bar and Y bar are just constants. They're just fixed values. They don't get affected as I work my way through the observations. So I can actually move this away from being here. But I put it here just to make my point that this is a standardized value. But I can move it over here. I can move it that far away. What does that accomplish? Or I could even move it underneath all of this. So let me show you what I mean. I'm going to change the page. Let me know if you want me to go back. I'm just recopying what I had. All right, and then this becomes, what I'm going to do is I'm going to extract these two and put them here. I could put them here, I can put them in front here, but that would essentially be doing the same thing. Now, why do I want to do that? Because I want you to realize that the correlation coefficient is not just a measure averaging the multiplication of these standardized values. I want you to see something else. What is this thing on the top? What does it look like? Or if you know, you can just tell me what it is. What's this? If I didn't do it with y, and I put an x here, what is that? Now, you guys don't have to be copying this. If you can copy and it helps you, that's great. Just take a screenshot and try and pay attention. Whatever works best for you, but don't lose yourself copying. I want you to follow along. Let me take you through this, okay? So my question is, what is this? Great. That is called the variance. This is called the variance, right? So if that's the variance, what should we call this? I'm not taking the deviations from the mean squared. I'm taking the opportunity to take the deviations of the mean from one variable and the other. This is called covariance. And it picks up it's a measure of the direction it's you know what, I'm going to say it's a measure of the direction or the trend of the linear relationship between two quantitative variables. It's a measure of the direction. It doesn't exactly tell you the strength because from variable to variable to variable, when you're getting their covariance, it sort of muddles, like you don't know what that number really means. The beauty of R is that R is between -1 and 1, and we know what the R means. We'll know that if it's close to 1, positive, then it has a strong positive linear relationship. If it's close to -1, it's a strong negative linear relationship. If it's 0.05, it's not a strong relationship. But we don't know when we finish calculating this what that number really means because it's not standardized. So R is really just a standardized covariance. That's what R is. It's really important to realize that because I'm going to play around with these variables and you need to know the relationship, okay? So covariance is calculated like this, you know, oops. You can do this with using the table. Is it in your calculator? That's my next question. Can you find this in your calculator? Some people have different calculators. If you use the TI 83 or 80, that calculator, the programmable calculator, you can make lists and compute it. But in the BA2 Plus, do you guys know how to get that number? So my question is, what was my question? Can you compute covariance in your calculator? I'm going to say directly or indirectly. Now obviously you can do this all in Excel very quickly. You can do this all in Excel very easily. But I want you to know the power of your calculator and using it because, again, I like to prepare you for the CFA exam. That's my motivation. And I know that you only get to use the calculator, so I got to prepare you to use the calculator. You have it on your calculator? Okay, so let's go to the BA2 Plus and well, let me show you like this. This is what I would do with the BA2 Plus. Since, stick with me, since R is equal to cov xy over sx sy, and the calculator gives me sx, sy, and r, I can find cov by multiplying r times these. Yes, you can get those sums too. I think it's easier to do it this way, but you guys can find your way. The calculator, it will not give you the value directly, but you can find it indirectly. Yes, there's another variation of this formula that, oops, that I'm not going to show you, but it does, it regroups all of these so that it's in sums, like Tiana's mentioning. Like it does sums of x, y, and x squared and things. But I'm not gonna focus on that. I'm gonna do it this way. So you could solve for covariance xy. Okay, now I run out of space. Let me say I'll divide the page. So covariance xy is equal to r sx sy. All right? So everything I just said, the pattern of what I've just discussed is also visible in the bottom problem where we're using ex-ante data. Very good. Jennifer, let's see. I'm going to check. Oops, sorry. I'm going to check. Yes, very good. You got the number. Okay, so you can find all the values very easily. You don't ever have to use the tables, except like in the test, I might give you 3 values, so you can practice with a few values. In a test situation, I won't give you a lot of values to compute with, because I don't want to spend time on that, but you should, I want to encourage you to understand these formulas and be able to reproduce them in tables. The calculator could be a black box where you don't know what it's doing, and that is not, that's not what it's intended for. I mean, I wouldn't intend you to use the calculator just to forget about what's going on. I want you to know what's going on and just to make it facilitate, make the calculations without error and occur faster, okay? But you really should know what these formula are doing. All right, so questions? Oh, you guys can't see my stuff on this page. Let me move this up before let's see if I can move this up. I'm going to erase this. Oh, it won't let me go so high. Okay, so covariance is the measure of direction of the linear relationship between two quantitative variables. So if it's a positive, usually we use it and say, oh, if it's positive, they're positively correlated. If it's negative, they're negatively correlated, but we don't know how strong that relationship is. So that's really important, and that's why we use R. We standardize the values so we can talk about how close those observations fit on the line. Okay, so let me go back. Ready? Take a screenshot. And we're back here. Okay, the last thing to say, and I did mention this last class, oh, let me scratch this out so we're not meeting that day, because, right. So whatever we finish next week will be where we end off for the test. All right? And I'll give you the materials by the end of today, so you have everything for the test. And you have 2 weeks to study. And you get to use all your materials. As long as you don't communicate with another human being, you are in the honor code of the test. Oh, yes. Okay, so all of this here, this was the formula that I just discussed, which can be written like this, it could be written like this, and this is the one I use for illustrating what the heck the correlation coefficient is. Now the slope, you just got that on your calculator as well. In general, this is the formula you should use for simple linear regression to calculate the slope. This is the formula. Now you might say to me, wait a second, isn't it just this? Well, yes, this is the formula if the values fall on a line. But in general, if they don't fall exactly on a line, you use this formula. Now this is derived by optimization, and this is by minimizing the squared residuals, so that basically you're finding the line that fits best between the points. It fits closest to all the points. And that formula does it for you, okay? So we want that line that we pick, the best line would be that floats so that the values, the distance here, which are called residuals, and the distance here, which are called residuals, the total distances are offset, because these ones would be positive because these values are above the line, and these values would be negatives, these values are below the line, and the line would fit so it floats equally between the distances, okay? All that said, this is the formula that will get you there. So I'm just gonna move this a little bit up because I feel like I'm missing things. I think that's how I had it before, and then I tried to fit more on. Okay. So what is this formula? Let's go into it. Oops, that's not it. All right. I'm not sure you guys can see that. I didn't know if I did much there. Okay, so this formula is the slope formula when you have a scatter plot. This is the slope of the least squares prediction line. It's called least squares because when the formula that minimizes those residuals is used, you have to square the residuals before you minimize them. You minimize their differences. Anyway, don't worry too much about that unless you're going into statistics, or if you're going to learn this in higher level courses. If you do an MBA or if you do finance professionally, you'll learn more about that. But for now, this is all you need. You need to know that the slope is equal to R times SY over SX. And this is great for finance because this mnemonic device will help you remember the order. It's R times SY over SX. The Y comes first, in other words. Spelling risk. And B, like I described before, is like a measure of risk, of sensitivity. It's a measure of sensitivity, or we interpret it as a measure of risk. When we talk about financial variables like we just did. All right? So that comes in handy. So this is made very easy once we have R, which we have as 1. SY was point whatever it was, and SX was whatever it was. We can get the B. Let's do that calculation. Actually, I sent you the solution so you guys can see that. But it's a very easy calculation to make now. Let's see. I have SY over here and SX. Right, SY was 0.3, no, SX was 0.3, and SY was 0.6, okay. So if the information is R is 1, SY is 0.06, and SX is 0.03. Now where do I get those numbers from again? Those are all from my calculator, right? So that's in the calculator, that's in the calculator, that's in the calculator, you see? So you can find the slope, but the slope's also in the calculator. Anyway, but that's how you would get it. So if you put all that together, you get 2, don't you? Because SY divided by SX is 2. So you get B is 2. Questions? So this is not so bad. These formulas look a little menacing because they look like they're many, but that's it, that's it. All the formulas that you need are on the top. All these formulas are on the top that you need. X bar, S, and covariance. And with those, you can get all the other values. So I sent you the solutions to this for you to work through. What I recommend is think about when you write out your solutions that like you would if you were using Excel, use the columns. It's the easiest way. Let me see if I can pull up my solution set. If I put it in here. It's not there, it's over here, I guess. Oh. Let's see if I have it here. No. All right. So here are the solutions that I sent you, and what I tried to do is maintain these columns. So all you're doing is replicating the data set up here, and then in the column you just write X bar all the way down. Okay, so it's kind of what you would do in Excel if you were to do this manually in Excel. If you had to present it on a test, you could do it that way. I wouldn't mind. All right. So what I've taught you, this has been a review of statistics, and I finished, I ended the review with an example of what we're going to do with it. Okay, so are we going to combine this with TVM? I'm trying to think. I mean, I'm going to give you problems. Then basically we're going to use this to, we're going to work with it to derive, the goal is to derive the interest rate, the risk, the cost of capital. That is our goal. Okay, so that is done by taking into account risk as measured by the volatility of returns in the market. So it all comes down to this, standard deviations, which are based on means. So it's all statistics. It's all statistics all to get us to the cost of capital. So does TVM come back into it? I'm trying to think. I guess so, because the goal is to get R, and R is the interest rate that's used in the TVM formula. So I guess it all comes together that way. Am I answering your question? Anyway, you'll see. You're anticipating where we're going with this. So the goal is to use all of this to determine the risk, adjusted rate of return for different investments, projects, assets. So we're looking for, the cost of capital, essentially the discount rate that we used in valuation. All these terms are the same thing. Okay? So I need to teach you these techniques because it's actually a review of these techniques, of these calculations. All right, so you were saying you want to review covariance. So here is the data for the mean. You could also do this in a column, and the two means. This is the variance, you see, so I copied that here, and then the mean of X all the way down, square. Then all I've found is the variance. I have to take the square root to get the standard deviation. Do the same thing for Y, and then let's get the covariance. So here's the covariance. So here are the two columns, right? X minus X bar, so these are the X's and the X bar all the way down. And then Y minus Y bar. Here's Y and Y bar all the way down. So that's how you would do it manually to get this number, but in your calculator, I showed you, if you want this number in your calculator, you take the fact that R is equal to covariance XY divided by SX SY. So that means covariance XY is equal to R SX SY. You multiply the three things together and you get that answer. So R was 1, SX was 0.03, and SY was 0.06. Got it? So I could ask you to demonstrate how you get the numbers, not just to use your calculator. And when I do that, it's intended so that you don't forget where these numbers come from. You should be able to do both. Use your calculator and write out all these results. I know the students come to this class, most, I'd say 90%, don't feel confident about statistics. But when I start, all this stuff comes flooding back to them. Is that your experience? Like you're remembering all of this? Because you've done this before. Obviously not in this context, but you've done this before. Made these calculations before. So this is the solution set that I sent last week. To calculate the R, you have to do this with the covariance calculated manually and then the two standard deviations manually, and as messy as it all looks, it ends up being 1. And finally, then we find the slope of the linear relationship between BCE versus, notice when I write it like that, usually we say Y versus X. The Y against, versus against. Not that they're fighting, but that one is on the Y-axis, the other one is on the X. So the Y variable is always first. So we call this B the slope, and in finance it has a special name known as beta. Beta is just the Greek letter for B. Okay? And it turns out the beta is 2. So let's take a moment to look at the beta before I continue. Beta is equal to okay, so the question is, how do I get R if I don't have the covariance? Well, it's many, it depends on what you have. Remember, this is one way you can get R if you have that information. Another way is the standardized covariance, which is basically the same thing. And Also, you can find R this way. If I have that information. If someone gave me the beta or the B, the slope, and I had the 2 standard deviations, I could do that. So it all depends on what I have available to me. Okay, so for the test, if I want to see you make the calculations, I will say, show me the calculations. If I don't say that in the exact question, just use your calculator, okay? But be sure you're using it properly because you don't want to make a mistake. Okay, so you guys with me? What I did there? So this is one way of getting R. This is the way I'm going to count on for the class. Also, you could find R so R would be like this. R would be like this. If I want you to go to the tables, I will make it, you do it this way. But mostly you'll see it this way. Don't forget what R means. Okay, let's talk about it now then. So if R is okay, let me ask you the question. Let me ask you the question. Do R and B always have the same sign? So R is a measure of the direction and strength of the linear relationship. B is the slope of the least squares prediction line. Do they always have the same slope? I'm sorry, the same sign? Okay, Ariette made a guess. Who else thinks? All I should be looking at are the formula. Okay, Tiana says they're measuring the same thing. Okay, okay, the answer is yes, but what is the reason? That's not the exact reason. The reason is they're not measuring the same thing. Similar aspects. One is the slope, and this one gives you the direction and strength. But it's not as precise on direction as the B is. The issue is that SY and SX get multiplied to R. And these are always positive, right? Because of the square root of a number, they have to be positives. So they have no sign. I mean, they will never have a negative sign. That means that B will take the sign of R. So yes, R and B will always have the same sign. But thank you for your guesses. Those were good answers. Got me going, got me started. You got it? So the standard deviations have to be positive because they're the square root of something, and the square root of something for real numbers is always positive. And then you multiply it by r. So r is the sign, r's sign is the same sign as b. Okay, so we've done a dissection of all these formula for data that is historical or ex post. So it is looking back, giving every pair of observations equal weight or equal value. What if I have the other way of presenting data where possible observations have different weight? And this could be where I have collected a bunch of information and derived a dense probability distribution function or distribution that's discrete for the variable. So what am I talking about? I'm talking about this. So if the data are ex-ante, the information will be provided to you like this, and I'm only giving you 3 different states of the world because I'm using discrete outcomes and a limited number of them. This could be really long, but my point is not to make this precise, as I want to just illustrate how you could do this, and you could do the same thing if you had more numbers. Also, I want to say this is just a discrete distribution, but you could do the same sort of thing with a continuous distribution, but to do that, it's not good for this course because you need calculus to know how to do that, all right? So we just work with discrete distributions. So these are the possible outcomes, and these are their probabilities. Now, we know how to deal with that. We discussed this already, that we have to use these different formula for the weighted mean, the weighted standard deviation, this, which is the weighted covariance, this is the weighted correlation, and this is the weighted beta. That's all they are. Now they look a little different, right? Because we use the Greek letters now, treating the data as though it came from, it describes the distribution of the population for possible outcomes. So we allow ourselves to use the Greek letters. So you see, this is the weighted mean, weighted standard deviation, weighted covariance. We don't divide by anything, right? Because that's, the weight is taking care of that, giving equal weight. In the other example becomes different weights in this one. And then this is analogous. So this looks actually more simple, but if you don't know what it is, it can be very confusing. So this is my symbol for covariance. Let me make it bigger so you can see. My symbol for variance, dear. The symbol for variance is sigma. And oh, I didn't put the X on it. Let's put the X on it. And this one means X and Y covariance. And then here, this is the covariance standardized, you see? Covariance standardized, which could also be written like this or like this, but get used to seeing this because this is the way I'm going to do it. And then finally, so let me write that down just so you can see that. So this is like our covariance XY standardized. That's what that is. So when I write it like this, it's just to jog your memory that's what that is. It's just different symbols because we have to do this using the weights. And this one, remember B, risk, R, SY over SX. So that's why it's R, which is, so this is R in Greek letters, is rho. It looks like a P, but it's rho, which is R in Greek. Times SY, which is sigma Y, divided by SX, which is sigma X. So R is for the direction and the strength of the relationship. B is for the direction, and it tells you like it tells you the slope of the line. R doesn't tell you the slope of the line. So we need both of them, right? Because if R indicates a strong relationship, then B is meaningful. So we do need both of them. So for instance, if the data look like this, let me do that a little more extreme. Okay, that should be a straight line. Do that again. I was trying to make it more slanted. Hold on. So let's say that was it. So let's say the B here is 2. But the R, or the beta, no, we'll say B. Let's say B. So if the B here is 2, that looks like it's a very sensitive, risky relationship. But the R is so scattered, the R reflects that these are so scattered that B is not going to be useful for predictions. Okay, it could be really far off. Like, look how far these numbers are away. I mean, these observations. Okay, so B or beta will not be so meaningful. Now, the reason why I said I have to use B with this drawing is historical data can be plotted, but this non-historical data, this is ex-ante data, we don't plot that. Okay, because how do I plot that this is 40% and that's 50% and that's 10%? I guess I could, anyway, we don't do that. Although we can calculate these values, statistics for it. So what I did in the handouts is I solved these as well, and I stuck with the columns. So you should practice that. Is there a way of getting this nicely on your calculator? The Texas Instrument BA2 Plus? No, it's not. There's no nice way to get this on your calculator. So you have to know how to do this manually. And that would be the case for the CFA exam as well. So let me pull up. So you have all these results. You have all these pages. I'm just showing you how to work through them. Okay, so here are my calculations for this data, and I did everything in columns the best I could. I don't know, the columns got a little distorted in making the PDF somehow. So that was my intention here, to make a column with the P's and the X's. You multiply across. So you can see this can be done in Excel. The P's and the Y's, multiply across and add. Then here, the columns again. Here are the X's, here are the X bars, here are the P's. Here are the Y's, the Y bars, and the P's. So if you set it up in Excel, it should be easy to do. So I recommend that you use Excel on the test, and if I ask you to show your work, you're just going to recopy from Excel. It's just very easy to make a mistake. There's lots of room for error, especially down in the covariance. Here's the covariance, because you have to take the X's minus X bar, the Y's minus Y bar, and then multiply. Add them up. Any questions about this? So this is just for you to practice. Do you want me to show you how to do it in Excel, how to set up Excel, or you guys know how to do that? You can prepare an Excel page for yourself to make these calculations. So don't assume you understand. Make sure you sit down and you try to build an Excel sheet to make these calculations for yourself, all right? Make sure you practice replicating these results. I've given you all the answers, you just have to practice. All right, so that's it for my stats review. You can go back to these videos, you can go back to the notes, you can use these pages, especially these ones that we just did, as your formula sheet, right? Because all the formulas are here for Expost and Ex-ante. I also, did I send it to you yet? Let me see if I sent it to you. I created also a document right. I don't know if I sent it to you yet. I didn't want to confuse you. Maybe I did send it. So this document has the same exercise, the same formulas, but I've cast them using the notation that's in the notes and in the text with R's, R for return. But it's the same thing, you guys. It's the same thing. This is the sample mean. This is the sample standard deviation. This is the sample covariance. This is the correlation. And I put hats on things because this is for a sample. I guess this should have a hat too. So these are the notations that are used, but it's the same thing. And I don't need to see you writing these notations. All I need to see you doing is making these calculations. As far as, I want X bar and Y bar. The truth is that X is always going to be the returns to the market, and Y is always going to be returns to a stock or asset. If you want to do this in Excel, I feel like it's kind of wasting time, but if you really want to see that, So I could say X what's happening? Did I not pick the right option? Not as easy as I thought it would be. Why can't I select? I just used this yesterday. Oh, that's why, maybe. Nope. My keyword isn't. It's not working. No. I want to close it. All right. No, I can't. Well, I can't show you because I don't know how to get it to use my keyboard. Strange. So I have to look into that, why it's not working. See what I mean? Waste time. I don't know what's wrong with that. Anyway, so work with it in Excel and let me know if you have problems. I'll log on with you at some point and we can do a live stream of Excel once I figure out. Maybe I'll do it on my computer. I can do it on my computer. Maybe I can do it on my computer now. Let's see. Wait, this is really important. Okay, I'm working on my computer now. So, So if you want to get the, you can just calculate the standard deviation and the mean. like that, and then copy or drag these. Circle of death. I think I have too many things open on my computer. Okay. So if I copy these, there are my mean and standard deviation. And if I want to get, probably there's correlation, equals correlation. Probably do that, right? I don't know how to do that, but okay, if I was to make these calculations for a test situation, I could write I hope you're watching. And then you're going to take x minus the mean, and you're going to do that. You can put the actual number in there, or if you put dollar signs, you can freeze that so it always picks up that value over here, E8, and then copy it down. And then you're going to do the same for y minus y bar. Oh, did I do the wrong one? Hold on, let me check back. Yeah, no, I did the right one, 7, E7. Okay. So those are the means. Sorry, the deviations from the means. And for covariance, you'd say like that, and you multiply these together all the way down and sum. And for this Expost data, this would be the sum. And then this would be, if you take that and you divide by n minus 1, this is the covariance. Hope you followed that. Oh, mine, you can't even see that, can you? Okay, hold on. Let's see if I make that smaller. There. So what I did is multiply them together. Can you not see the formulas? Yeah, you can see. No? Oh, you can't see the formulas. That's funny. The formulas are not appearing. So let me write it doesn't appear. For some reason you don't see my formulas. I can see them. funny. Why would it do that? I don't know. So the formula is G5 times H5. So I hit equals, then I touch G5 times H5. And I have no idea why it's not appearing, but that's what I did. So that's it. That's all you need. You can't see any of the formulas. That's terrible. I can't help you anymore with that because that's, I don't know how to make that appear. But you scroll down. So I hit equals mean bracket, and then I select all the values here, and then I close bracket, and that gives me the answer. And for the standard deviation, I hit equals standard deviation. Does that show up? You don't even see that. Funny. So equals standard deviation in bracket. Anyway, you put all the values in there. And then equal, in this one, it was just equal covariance, not covariance, all I did was equal sum. And then divided by 4. That's the formula that I used. Okay? Questions? Then obviously to calculate R, you would say R equals, and then equal covariance, this one, I8, and you divide by E8 times F8. Anyway, you guys got to practice with that. I don't want to waste time with that because I can't even properly show it for some reason. The formulas aren't showing up. But that's how you would do that, okay? So practice with that and let me know if you get stuck. So find a tool that works for you. Somebody wrote me here. I'm not sure what the question is. Okay, I see your questions. Why 4, right? Because the covariance, the formula is divided by n minus 1. Thank you, Tiana. So I'm glad, it looks like you guys are trying. There's 20 of you logged in, so that's good. Looks like you're trying this. So try and see if you can get those numbers that I got. I'll give you, let's take a 10-minute break, and you guys can work with that, okay? Please try and let me know how it goes before we go on to the next one. We're going to do the other set. Sorry, I have no idea why the formulas are not appearing. And somehow my Excel got shut down on my iPad. It looks like it's working now. I had to just sign in. Interesting. Let's see if I can reproduce this. Oh, now it's working. Okay, this is on my iPad. There you see the formula. Okay. I don't want it to be uppercase. How do I do that? Okay, have you been watching or taking a break? So I use my iPad and you can see the formulas now. Maybe it's small. Make it bigger. And I made a mistake because that's not the answer. Oh, because that's why. I forgot to put that's right. All right, so that's it. I did it on I got my iPad going. Yeah, I had a mistake. I just fixed it. And that's that. So you got everything there, and with all those numbers you can calculate R It won't let me do lowercase. How do I do lowercase if it's the first letter? Alt, Shift Alt, I don't know. It wants to give me uppercase. Well, that's correlation. I'll just call it core. So it's equal to covariance divided by standard deviation times the other standard deviation on the bottom. And that's how you get R of 1. And then slope which is also known as beta for this kind of data, is R times Sy divided by Sx. And that's it. Questions? Check back on the formula. The formula for covariance is the sum divided by n minus 1. So go back to the formulas and see we always divide by n minus 1. Oops. Oops, not that one. Here. Oh, I need to get the formula. See, you're always dividing. The formula is always dividing by n minus 1. And the reason was, go back to the video where I taught you about standard deviation, and you will see why we divide by n minus 1. I spent a lot of time on that, so please remember if you watched it, or if you didn't watch it again. Like, it's not worth my time if you guys aren't going to watch the videos and rewatch them. It's not worth the time. So they're always n minus 1 for standard deviation, covariance, and correlation in here because that's the covariance. However, for this formula, we don't minus 1, we use the p. Because the p is always less than 1 as a sum. So it's always, all of them are less than 1. Please go back and watch the videos if you don't understand what we're doing. So if I would do this in Excel, do this problem in Excel, I have to position this screen better. So we just did all these calculations here. Now let's do these ones. We did the ones above, now let's do these ones. So I'll just move it up. Let's do, so we're going to put P for the probability. I'll put prob. And then X and Y. Remember, X is always the market returns, and Y are the returns on some asset. So copying out these numbers, here, just my computer is slow. Okay, let's see. I can't find the file. So I did an update on my computer and it has problems searching for things now. Okay, let's see. So this data is 0.4, 0.14, 0.3, 0.5, 0.08, 0.18, 0.1, 0.04, and 0.1. That's the data. And now what we want to do is get the mean as a weighted mean. So I'm going to take this data probably has weighted mean function, but I'm going to do the steps of the tables that I illustrated here. So what you have to do is you have to do probability times x all the way down. So you're going to multiply each one all the way down. And then you add them, and that's all you have to do. You don't have to divide by anything. And so it's 10 for x. Now we repeat the same thing for y. Get the data for y. I don't know, wait. And then you multiply them. All the way down, and then sum. So all you have are the means. Now the standard deviations. You make the table. Looks so bad, doesn't it? I do that because I don't want it to be capitalized. I need to be small. It should be like that. No, it still goes capital. X minus x bar. Let's do that. Oh, it's a title. I don't need an equal sign there. See, we're wasting lots of time doing this. I hope you appreciate it, though. X minus x bar. And then I subtract. Let's see if you guys can see that. You cannot see it. So I'm going to move this up. So now I'm going to take x minus x bar and freeze. You have to freeze x bar as G24 and copy it all the way down. And then do the same thing for y. We're going to do prob times x minus x bar all the way down and then you just sum. So it feels different because you don't have to divide anything, but you don't because you've pre-multiplied by a number less than 1, so you don't have to divide by anything. Expost calculations assume that all observations are equally contributing a fraction to the problem in the same fraction. Oops, I did something wrong. Oh, no, that's right. Oh, I'm probably have to show more decimal places. I don't know. Why is it not showing? Oh, I forgot to square, of course. That's what I did wrong. So you have to square the x minus x bar. Don't forget that or you're going to get 0. Didn't work. Oh, because it's a title. Oh, jeez. Now I have to square. Square. There we go. There it is. And this is the variance, standard deviation. It's sigma. I'll write that down. It's sigma x. Okay, so that's all I'm going to do because I'm not going to spend the whole class doing this. You need to practice that. See if you're able to see that. Well, you're going to have to practice, okay? Because I can't spend the whole class doing this. This is statistics. This is not finance. Kiana, there's nothing below. That's all there is. You have the answers. Work with the answers to resolve it. It can take some time, and that's all right. You're going to learn. If I take all of this formula and I copy it here and I just put the y in, and the y's are 30.18, .1, and then this is y bar minus x, y minus y bar which is not that. What was the mean of y? The mean of y was 0.22. All the way down. And this is for y bar. And that's, oh, this is the variance. Sorry, this is the variance, not the standard deviation. This is sigma x squared. I'm going to call it the variance. And this is the variance of y. Okay? And I'll make this smaller. How did I do it last time? Yep. So then you can get the covariance with these two columns and the probability. Actually, I just need these two columns. I need this one. Pasting the values, and this one. Pasting the values, and then I multiply them. And then for the covariance, oh, I have to multiply by this too. So you pre-weigh all of those quantities. And then finally, sum. See if I can work this. No, that's not working. This one, sum. There it is. And this is the covariance. Okay. And the rest I'm going to leave to you to work on calculating the standard deviations and the slope. And it turns out in this data set that the slope is also 2, and that's not as easy to see because the outcomes are have different significance, but it works out that the slope is also 2 in this problem. And the r is also 1. Okay, so I leave that for you to work with. You can re-watch the video, and I'm going to continue. So as I was saying, these are the same formulas here on this sheet. This is 5.7, where I've just given the formulas to you using R for returns, because the data is going to be return data that we work with. And I implore you, I don't want you to think these are new formulas. These are not new formulas. They're just formulas with R's in them for return. All these different symbols. These are just the symbols that we used before. Instead of S, they use sigma hat as an estimate. But you see, everything is the same. The pattern of the formula is the same. And then for ex-ante data, similarly, you have everything in R's for returns, but the pattern is the same. This is still covariance xy over sx sy. It's important to note that because in this data we're always putting the market returns on the x you'll see the symbol X. Oh wait, it doesn't fit. Let me make it fit. Okay, so I'm looking on, this is, I'll give you a moment, make sure you have this. This is 5.7 handout. Did I send this to you? After correlation, you find the slope B. Okay, so because X is always on the, we're always going to put X on, we're always going to put the market returns on the X-axis. Rather than X, we use M. So you see everywhere that X is, there is an M. Well, you see M for market. And then the other variable, the asset or the security or the one that we put here, some stock, we use, rather than Y, we use I. So I is for, I just stands, it's the symbol that we're going to use anyway for the stock or the asset, asset I. Everybody okay with that? You see what I'm saying? X is always going to be here, so we use the market returns are always going to be on the X-axis, so we use M. And the stock will always be on the Y-axis, so we use I. So if that's the case, so we went from B was risk R sy over sx. So that's if you have Expost data. If you have ex-ante data, you write it like this in Greek letters. R is now rho, sigma y replaces sy, and sigma x replaces sx. With financial data, I told you x becomes m and y becomes I, so that's why you have it like this, you see? Sigma I on top, sigma m. So this is just a translation for variables, but the pattern for calculating the variables is the same. Any questions? So there's not 100 formulas here. There are 4 formulas for ex-ante and 4 formulas for ex-post. So it's really 8 formulas. It's not hundreds of formulas. I'm trying to reassure you. So concluding, if I write beta I, because that's the slope of y versus x, it's going to be, this is in alphabetical order I and M, sigma I for the y, and then sigma x is sigma M. All right? Any questions about what I'm doing? The last formula on here is another way to calculate the beta, or the slope, of a scatter plot of points or pairs of observations. There's a last way to calculate beta. Can you guys tell me how or where this comes from? Let's look at it over here, because maybe you're more comfortable with the other. Let's go back here to this one where we all feel comfortable. Even I feel more comfortable. So let's look at here. Okay, these things are not going along with it. So let's do it here. So if we let R, remember we talked about how else to get R, right? We can also get R because R is equal to cov x, y, sx, sy, then we could find cov as R, sx, sy, right? So what happens if I substitute this? Let's play some more with this and substitute this cov into here. Let's say we didn't have R, but we had covariance. Someone gave us information on covariance. So we would put that in here. Oh, I'm having a message. Hold on. It's my niece. So this is, I'm going to cancel with that. Are you guys able to see? Yeah, you're able to see. So this is covariance xy Sx squared. So this is another formula for the slope, which is important. What is Sx squared? That's right. So what we see is slope can be calculated like this as risk with r sy over sx, but it can also be calculated as covariance over variance. Okay, so it's the variation in the relationships of x and y divided by the variance of x. So that's another way that you can calculate the slope. Now let's go to the other notation and do it again, okay? So you guys, we're going to reinforce this with different notation. So where am I going to write that? So there's a few formulas here. Like I said, there's 8 formulas. I guess this will be our 9th. So this is covariance xy over variance of x. Now let's do it for the formulas below. How would it look like? This would be, I would substitute all of this in. Sigma xy, sigma y over, sorry, that's not clear, hold on. Sigma xy over sigma x, sigma y to substitute the correlation, and then sigma y over sigma x. So these cancel, and again I get the same result. Covariance over variance. So the slope captures the covariance for the variability of x. The covariance of x with y given the variability, or as a ratio of the variability or volatility of x. All right, and the final one, let's go to the final 5.7 document. You ready? So it's the same formulas, they just look, they have different labels or different notation. Where am I going? I'm going to go to 5.7 and do the same thing here. You see? Now substituting, no, not that. Substituting, okay, I guess it's going to be this one here. Putting that in there will result in that formula. This is the covariance of x with y, because x is the market and y is the asset on the y-axis, and this is x squared, the market return squared, because the market's on the x. And that's it. Okay, so I've covered all the formulas and it's 11:30. So let's see what else I left for you. Any questions, first of all? So, can we use x bar and y bar to get the slope? Yeah, I mean, you can. That's what we're doing. That's where it comes from. There are other formulas There are other formulas with X and Y and X summation formulas, but then I'm adding a bunch of more formulas, and I just stick with these ones. Just as well stick with these, okay? So let's see, let's go into the materials I gave you. Okay, let's go to the notes. All the solutions, the answers are, I gave you the answers in a document, 5.3 and 4, no, 4 and 5, no wait. The solutions are in 5 and 6. 5.5 and 5.6 has all the solutions, so you can check your answers. If you don't have those, let me know. But I did send them. So you can check your answers. So here we are. What are we going to do with this information, all these tools? Now the tools of statistics we're going to use to actually calculate those returns. So notice I gave you the data like X and Y, where these were different sets of returns. X were the market returns, and Y is an asset. But the question now we're going to tackle before we start exploiting them, the question is, where do these come from? These are calculated for stock, if we focus on risky assets. For stock, it comes from the dollar return measure. The question is, what is the difference between ex-post and ex-ante? Does anybody know? Ex-post is historical data. It's historical data, and every value is treated the same. Ex-ante, every value is not treated the same. They have different weight, and they were determined by other information, not just historical data. Some modeling, expectations of the economy, and other information about industry derived these outcomes, possible outcomes for these states of the world. So ex-ante data is a combination of historical and other financial data to come up with this discrete distribution. So that's the difference. Ex-ante means before it happens. Ex-post means after it happens, because this was in the past. Is that okay? Ex-post, after the fact. This is the history. And I have no reason to believe any one value is more relevant than the other. Ex-ante, I incorporate the belief using other information to predict before the fact, to predict what's going to happen. This happens with 40% chance, boom economy. A normal economy happens with 50% chance, and a recession happens with 10% chance. So, where do these returns come from? They come from information about, if you're holding the stock or looking at holding stock, you look at what the dollar dividend is expected in the next period. So we're going to go period by period, and we're going to look at using historical data, okay? Also, the value, the return in dollars for holding a security is the change in market value. So in the next period, what is the price change? If the price goes up, that increases the value of my stock by this return. Even though I don't necessarily sell the stock, I could and realize this change in market value. So these are the two components of the return to stock. The dollar dividend next period plus the change in market value. And this is the notation I'm going to use. Okay, T you can think of as today or this period. Okay, so that's today plus the change in market value from last period to now, to today. Or T for time. Okay, so what you can do is compute that as a percentage. This is it as dollars, now as a percentage. So what you're going to say is, compared to last period, what is the return? So the percentage return would be in notation divided by the price of the stock last period. So it would be relative to last period's price. So this is R, this is where the R comes from. This is the return at time T is equal to the dollar dividend divided by the price last period. You can write it like this. You could write it like this. You can write it like this. So depending on what interpretation you want, you can write it that way. In this interpretation, I divide the denominator to both the dividend and to the price change. And I call this has a name, it's called the dividend yield. And this portion is called the capital gains yield. This turns out to be a percentage, they both turn out to be percentages and components of the return to stock over a period T. Where we use this notation, I use this, and this is economics. You see this in economics, you see it in finance. This is the percentage change notation. To calculate the percentage change of any metric, any variable, you would take the new value minus the old value and divide by the old value. So for instance, PT minus PT minus 1 divided by PT minus 1. This is percentage change in price. Okay? All right, so having said that, and this is the formula, given the formula that I showed you before, you see this is the one we talked about. We've been using this formula actually since the beginning of this course with some assumptions. If we compute the returns over time and we assume a constant growth rate, if you assume a constant growth rate in returns, this simplifies. So I'm going to say it's not going to be all of the T's, all the time periods into the future are related by a constant growth rate. That growth rate we've been calling G. We've been calling that growth rate G, all right? Then if we think about time last period as, the beginning. So I'm going to call time t minus 1 the beginning of it. So that's PV0. And I'm going to call the next dividend C1. And I'm going to say that the growth rate is G. What I've done is found the return that's constant over time. So we've been doing this. We've been using the same return I in a formula like this one for the valuation of stock as a growing perpetuity. So we've used this formula. This is the valuation of stock as a growing perpetuity. We made some assumptions about what we felt the growth rate would be. And we used the next dividend as the first cash flow, and we said the rest are related by G. And we assumed that the rate of return would be constant. So this formula is a specific case of this more general formula. So I'm going to take away the assumptions, and this is what we're going to use now. So this is our return formula, and because the returns can change over time, I'm going to put a T instead of fixing it as a constant I. So this is data. And, this is going to give us, we're going to use information on prices from the past, dividend expectations or relationships between dividends to calculate returns. And what do we do with returns? Von Madi is asking. We do what we do with returns. As I explained, for all data, you can, assuming you have a certain kind of distribution, make some predictions, and we're going to get to that. But essentially, you have all the tools to do this already. Maybe you don't know it, but you do. So let's see. Here we go. Calculate for this information on stock, you have the initial price per share. It paid a dividend of 0.84 during the year. And it had an ending price of 46.2. What is the return? So we're building, what we're doing with this information is building that data set, right? The X and the Y is what we want to get to. We're building a data set. So if you calculate, this is the initial price. So the price, you can call that, if you don't want to put a thing on it, it's initial, so T minus 1. And it just paid, oops. And it just paid this, so this is going to be DT. And the ending price, so PT, is 46.2. So the price went up. So now you're going to measure the percentage total return, the dividend yield, and the capital gains yield. So the dividend yield was DT over T minus 1. So the dividend over the original price. So the dividend as a fraction of the original price. And the capital gains yield was the new price minus the old price, so it's a percentage change over the old price. So this is going to be the new price of 46.2 minus the old price of 42 divided by 42. And when you compute this, what do you get? My lines are not turning out straight, are they? So you're going to find that this one is 0.2 or 2%, and this one is 10%. So the total percentage return is 12% or 0.12. Okay, depending on what you want to do with that, those are the values you would include for that outcome. So again, back in Excel, you can imagine making, collecting data like this and making columns of data. So I'm going to show you a data set. We have 5 minutes. And we're going to talk about the returns. So this is a review of what we talked about, a little bit, an extension of what we talked about. When you get data, you can calculate, you get a set of data and you want to estimate the expected value, and you want to use that to say something about the future. So with returns, just like we just calculated, if you have a table of return data, you might want to know what was the return over that entire time. So if the returns are different, you would calculate as factors 1 plus the return times 1 plus the return, and you would figure out the return over a period of time minus the principal 1, right? Because each time you included the 1. So for every dollar invested over that period, that's what the return was, and then you left it to compound with another return and so on till the end. So you take off the principal amount, and that tells you the holding period return. We're going to make these calculations in a minute. So that's a measure of the return over a period of t years. What about if I want an average, so like an expected value each year over that total period of time? One way to do that is the geometric average return, and the other way is just take the mean, the average. The mean is just adding them up and dividing by how many there are. So we've seen this before. Remember, I'm just replacing x with r for returns. So this would be the mean, and this is the geometric mean. We treat the returns as factors, multiply them together, and then taking, because they're compounded, we remember what we learned when we learned about effective rates, and we calculate the effective rate on average over that period. So we do that in the exponents. So there's t periods, so I take a factor, fraction, but in the exponents, because this is a multiplicative compounding relationship. I slice it up in the exponents. So this gives me a measure of expected value. This gives me a measure of expected value. If they differ, so if these two differ, you use the GAR. The GAR is a more robust measure. Remembering the sensitivity of the arithmetic average, it's very prone to extreme values. Okay, so in the event that we have some extreme values, we use the GAR, the geometric average return. So let's look at some data now and make these calculations. Now I'm going to speed through this because we don't have much time, but you can make these calculations yourself. Practice. So here we have data and this is where I'm going to end off. This is the data for the market returns. These reflect the state of the economy, the state of the stock market reflecting or mirroring the state of the economy from 2007 to 2010. This was when the global financial market crisis erupted. And you see the returns to investors in the stock market holding this index, so they're invested in this index, or they're invested in a portfolio that mimics a market portfolio. They're getting 5.49% return in that period. And this was calculated using methods that, this includes many stock. It's, 500 companies are included to calculate this index. And, but similarly, things go into consideration just like we talked about calculating return on one stock. The dividend and the market value go into the calculations. This was when Bear Stearns declared bankruptcy and just created a ripple effect. People sold stock, the value of stock plummeted in a lot of for a lot of companies. The overall average the return that was measured over 2008 for the S&P 500 was negative 37% return. The following year, this was recovered, but not completely. And then in 2010, it was about 15%. So the question when you look at this data is, did the market recover between 2007 and 2010 for the loss in 2008? So how would we figure this out? We can calculate the holding period return to see what happened overall. We can look for the geometric average over each period and the arithmetic average. So I'm just going to show you the results, but I beg you to try and punch these in your calculator or use Excel to figure them out yourself. What you find is the overall, if you look at all the periods, if you invested $1 in 2007, you left it in the market index, you left it invested in a portfolio. For every dollar you invested, you lost 3.3%. So that's cents on the dollar, right? That's 3 cents for every dollar. Each year, we measure that your loss was a fraction of a percent, so 0.8 negative. But if you were to get the arithmetic average, it looks like the return was 2.5%, which is not capturing this effect or this effect. So as I explained, if these two are different, geometric average return and arithmetic average return, use GAR, okay? So why did this happen? Because you had some extreme values. You had that minus 37, and that really affected the calculation of the return. You have the minus 37, then you have two high values relative. So you have a very distorted set of numbers, and the arithmetic average is really affected by that, okay? Because remember, the arithmetic average intends to balance the numbers, and it doesn't care too much about where the expected value is. Questions? So, what I'm going to ask you to do, because we're over time, is read the rest of these notes. We've done all the statistics. You should be able to read this. You should be able to recalculate all these numbers in here, and we can have a discussion next class about this, and then get into the risk return material. And you'll just have to. I'll send you the new set of notes as well. It's really just a matter of reading through statistics. Unfortunately, I spent too much time on Excel today. People wanted me to do Excel. Please practice. I'm not going to do that again because we don't have any time to spare. So practice making these calculations. You have all the solutions. I've given you all the solutions. I will send you the next set of notes with problems and solutions so you can start working. All right? And whatever we finish next week in class will be included on the test. Okay? So I'm going to stay here if you have any questions to answer them. And Otherwise, have a good weekend. Good week. Yeah, the data is very strange. Whatever it does, it distorts things, okay? When the geometric average return and the arithmetic average are different, stick with the geometric average return.